Welcome to this webcast about the Dynamic Risk Management Project. This webcast is number 2 out of 2 webcasts following our initial webcast series in October 22 about the DRM model. This follow-up webcast focuses on the IASB's redeliberation on the performance assessment. Specifically, it further explains the recent tentative decisions of the IASB in relation to the introduction of a capacity assessment to support the DRM adjustment recognized in the Statement of Financial Position.
Prior to IASB's redeliberation, the DRM model included 2 prospective assessments at the beginning of the DRM assessment period. One test against the risk mitigation and the other test against the target profile. This was supplemented by 2 similar retrospective assessments at the end of the period. These assessments determine whether an entity can designate and continue with applying the DRM model similar to effectiveness requirements under the general hedge accounting. The entity would then be required to perform a separate lower-off assessment to determine the measurement of the DRM adjustment for each period. In its February 2023 meeting, the IASB tentatively agreed to make 2 changes to the DRM performance assessments. Firstly, it tentatively agreed that retrospective assessment against an entity's target profile would not provide useful information to the users of financial statements and therefore would no longer be required. In addition, the IASB also tentatively decided to require an entity to perform a capacity assessment to assess whether the current net open risk position at the end of the DRM assessment period can realize the expected benefits represented by the DRM adjustment, that is, in the form of reduced variability in earnings or economic value. We will focus on this capacity assessment in a bit more detail in this webcast.
Some stakeholders commented that the current DRM mechanics tentatively agreed by the IASB and explained in our previous webcast series may not capture the full effects of unexpected changes. This is because the retrospective assessment would only consider the effects for the current period under assessment, the so-called one-look-back period. However, the DRM adjustment is accumulated over time based on interest rate movements in multiple previous periods. As a result, when there are large prepayments or unexpected changes to the underlying items, there may be significant impact to the extent to which the designated derivatives mitigated the variability in the fair value of the risk mitigation intention and provided offset to the net interest income in the future. For example, if in the current period a significant portion of the previous outstanding fixed-rate assets with high coupon rates were repaid early and replaced by new fixed-rate loans at the current lower market interest rate, the entity would likely see a significant reduction in its economic value and future net interest income, driven by the interest rate differential on the portion of assets being replaced. Therefore, continuing to recognize the full amount of DRM adjustment no longer provides a faithful representation of the actual economic phenomenon, since the economic offset would no longer be available. The one look-back period retrospective test would not reflect this effect accurately if the market rate changes happened in previous periods.
We have considered a number of approaches, such as tracking of the change in fair value of the underlying items, or extending the one look-back period test to multiple periods. We did not proceed with those options because looking back to prior periods usually leads to complex tracking requirements. In addition, entities usually consider the risk at the aggregated level rather than focus on individual items, which makes the tracking even more complicated. Instead, consistent with what the DRM adjustment represents, we focused on the future potential protection or benefits the entity would be able to realize. We call this the fair value of the CNOP, which is forward-looking and represents an entity's maximum capacity to realize the expected benefits of reduced earnings or economic value variabilities. And that is based on today's CNOP. This is a snapshot view of the entity's risk exposure at the assessment date, assuming no further change in the CNOP until the end of the managed horizon. We did not specify the detailed methods on how to calculate the fair value of the CNOP, as we expect there could be multiple ways to do that in practice. However, we plan to discuss some more detailed principles or guidance on how to determine the fair value of the CNOP at a future IASB meeting.
This capacity assessment will ensure that the DRM adjustment is not recognized at an amount higher than the expected benefit of reduced variability to be realized in the future. Any excess of the DRM adjustment over the fair value of an entity's current net open risk position is recognized in profit or loss in the period of the assessment. It is important to note that this is an additional test, and it only provides a reasonableness assessment of the current DRM adjustment without claiming to be an accurate position. Unless there was a significant change to the underlying positions, we don't envisage a failure of this capacity assessments to happen frequently, which means that in most situations the lower of the life-to-date fair value changes of the benchmark or designated derivatives will be the appropriate basis for the DRM adjustment.
Thank you for the explanation, but could you please elaborate more on the advantages of this capacity assessment?
That is a great question. As we summarized in the staff paper, there are at least 3 advantages comparing to other approaches considered. A. Firstly, it is based on a snapshot of fair value of the current net open risk position at the end of the DRM assessment period and does not require the entity to track the full history of risk mitigation intention and the changes in the underlying items, unlike the other alternatives. This method is a natural extension of the current retrospective assessment in the DRM model, where the entity already needs to consider the effects of unexpected changes and identify the current net open risk position at the end of each DRM assessment period. B. Secondly, it's consistent with the holistic risk management view on which the DRM model is based, as there is no need to identify which or how much of the individual underlying items were designated for risk mitigation purposes in prior periods. And C, in addition, it provides a systematic solution to ensure that the DRM adjustment in the statement of financial position is being used for providing the appropriate economic offset, and any excess amount is recognized immediately. We hope you find these 2 follow-up webcasts useful, and thank you for your attention.